Preferred Apartments was listed in 2011 and was listed as an externally managed real estate investment trust. And as the name suggests, it started life investing in residential accommodation, or as the US guys call it, multifamily, and we're now calling it build to rent here in Australia. By 2018, the stock had expanded and had invested in student accommodation, had invested in retail assets and office assets. So it became a more diversified vehicle, and along with that diversification, they used a lot of debt and preferred equity to facilitate those acquisitions. So it became something that we really wouldn't ordinarily look at. The good thing was it was at least geographically focused in the Sunbelt states. Wind forward to 2018 and the founder of Preferred Apartments passed away, and that sort of triggered a little bit of a change of strategy where management was internalised. And that for us was a big tick from a corporate governance perspective, because you've now got a better alignment of interests between ourselves as potential investors and the way the company is managed. So we're moving towards something more attractive. Subsequent to that, COVID came along, and along with most real estate investment trusts that were highly geared, COVID wasn't a good outcome. And what we saw was the share price, particularly of the highly geared stocks, fall dramatically. And in the case of Preferred Apartments, the share price went from $16 odd from $16 to $5. So now you've got a situation where you've got a stock where the governance is a lot better. With the share price collapsing the way it did, valuation starts to look appealing. And the other thing that happened, along with any crisis, a good management team will use a crisis to make some changes, and that's what happened with Preferred Apartments. They used the crisis to streamline the portfolio, firstly by selling the student accommodation, and subsequently by selling most of the office portfolio. And they used those proceeds to repay some of the expensive debt. Still a highly geared structure, but a lot more favourable in terms of capital structure. And I think it was April 2021 where the transaction to sell the office assets completed, and at that point we initiated a position. So we now got a far more focused story that's attractively priced. Along with COVID, or one of the positives from COVID, particularly for Preferred Apartments, was the fact that people could work from home, and the ability for Americans to exit states like California and New York to move to places that gave them a better standard of living and still able to carry out those jobs, meant that there was quite a strong demand for residential rental accommodation in more attractive places. And along with that came a rise in the value of those assets. So suddenly leverage is working in our favour. We've got a rising value of the assets, we're still quite geared, and the share price started to rise quite strongly. And we took advantage of that renewed, or that different dynamic, to increase our exposure. We could see you've got a far more focused stock now, where there's demand for their assets, rent is growing, interest rates are still very low, and the share price started moving up. So we increased our position accordingly. And I think to give us a little bit of comfort, we were starting to see a little bit of corporate activity. I don't think the market still recognised the value in these assets, but we were comfortable with that and given some comfort from the corporate activity. Ultimately what happened, Blackstone came along and put a bid on the table for Preferred Apartments, so they saw the value as well. The price they put up was $25 a share, so that compared to our average price of around $13. We took advantage of the strength. We didn't actually sell into the bid, we sold the stock on market for a small premium to the bid price. I think people were speculating that Blackstone may end up paying more, which they didn't.